Next up, we've got Gary Gensler, who is a professor of the practice at MIT Sloan and formerly the chairman of the CFTC.
So I'm going to, I was asked to chat a little bit about Facebook's Libra token, and I'm going to put it in the context of payments and what's going on, and do it quite quickly to take as many questions as possible. So we all know how this all started. Satoshi Nakamoto writes a paper, Halloween night, 2008, and puts it out on the cypherpunk mailing list. But I sort of come back to the basics, how he started. He said he was going to have a peer-to-peer payment system, a cash system. Hi, Kevin. Good to see you. And so has this led to a payment system? So this picture was taken this morning in Vienna. There are Bitcoin ATMs around. And so, all right, but it hasn't really changed the payment system. Not really. What we really have is we have a speculative crypto asset market, $200-ish billion. Thank you, CoinDance, for these statistics. That's really where we've been to date. But stable value tokens have come about, and I think we need to think about stable value tokens and think about Libra in that context. We all know Tether. Tether and other stable value tokens have largely been a gateway for crypto exchanges to trade. So it kind of goes back to this, that Tether is an affiliate of Bitfinex. It's not being really used in the overall system. But there's a bunch of big finance systems as well. Finality, which we've heard about, which is 14 major banks that are looking at the intrabank payment market. And then JP Morgan and Wells Fargo have some intrabank inside of them. And even Mizuho Financial is using sort of an inspired technology, but it's really a traditional database technology. What are the gaps that everybody's trying to get to? The cryptoeconomics. And just to stay with this for a second, this is what's also driving Facebook in a way. This is driving because this is about filling payment pain points. Whether it's extending to 24 hours a day, 7 days a week, to have an ability to have round-the-clock continuous settlement. That's what the Federal Reserve recently announced they're going to try to do by 2023, that you could do that, sort of Venmo for everybody, continuously. Or whether it's a gap between payments and securities markets, delivery versus payment, or what's called DVP, which is another form of atomic swaps between the securities markets and the payments markets effectively. That's what folks are trying to fill. Also, there's one gap that I don't put on here, which is payments cost about 0.5% to 1% of the world GDP. In the US, that's 100 million to 200 million. Visa takes about 21 billion, 100 to 200 billion. But globally, that's something closer to 400 to 800 billion dollars. So those are some of the costs and rents. And central banks, I believe that cryptocurrencies have been a catalyst for change, that central banks are pushing the edges. We know about the Canadian and the Singaporean and the South African looks at using permissioned blockchain technology to do payments. What they've basically found, and they've got some great economists working on it, is it's doable, but not necessary. And that's important. The work of Singapore and Canada, yes, we can use this technology, but we don't have to. It's not clear to them yet that it has great advantages. Now, Rob, one of my colleagues here, is trying to promote that there's greater advantages, but they're still looking at that. That's fair, right? And then you have what's called digital currencies, and I think of them in different buckets. Truly central bank digital currencies, commercial bank digital currencies, which I would note the People's Bank of China is not truly a central bank digital currency. It is a second tier or second layer currency to be issued by commercial banks within their system. And so I would just always say, watch out for the vague vocabulary that's used, and I might be even inaccurate here. Some, like Uruguay, I couldn't quite really tell what Uruguay was, even though lots of people talk about it. In essence, is it a direct liability, a direct call on the central bank, or is it intermediated between the central bank and the public? And by the way, we already have digital currency. It's called Bank of America, Chase Manhattan Bank. Well, it's now JP Morgan Chase, but Wells Fargo. We all have digital bank accounts. So it's in that environment. FinTech has gotten into payments. Startups have gotten into payments. We all know the story of China, that Alipay and WeChat Pay are dominant in the payment system. And yes, the central bank, the People's Bank of China, had to get their arms around it. And in Africa, in Kenya, Safaricom, a telephone company, got into the payment space. Now, what does this all mean to Facebook? Facebook has watched this and said, we want in as well. We want to do what Alipay or WeChat Pay or even any of these startups are doing in this space, because if you can get into payments, you can maybe get into credit. And if you get in payments and credit, you can start to make some of the profits that the financial sector is making. One last thing before we dive into Libra is they're not the only messaging company looking to do this. And Telegram, with 370 million members, only about 15 or 18% the size of Facebook, but still big, an encrypted messaging service, will at some point roll out Gram. They raised $1.7 billion. No, I think they will. I think they will. And that will be an interesting time as well. So Facebook has tried 3 times, and I would say unsuccessfully tried 3 times to do what Alipay or WeChat Pay or others have done. And in fact, the very first one is nearly 10 years ago, a virtual currency in 15 currencies, terminated in 4 years. And even the most recent ones, they pulled out of France just earlier this year. So they hired David Marcus, who ran PayPal, who earlier had a very successful payment startup. They want into this space. This is a strategic initiative they want in. So where are they on their 4th attempt now? Is they're saying, all right, we're going to promote Libra as a global digital currency. There's nothing that lacks ambition in this. A global digital currency and payment solution. They're saying we're going to create a reserve to back it, initially US dollars, euro, sterling, and Japanese yen, of government securities and bank deposits. So it's not Bitcoin, it's backed, but it's not a single stable value token, it's a basket approach. And one of our colleagues from MIT, Christian Canalidi, is their chief economist and has come with this idea of this stable token approach. No interest is to be paid on this token. So this is a non-interest-bearing token. And they use exchange-traded fund mechanisms to stabilize the value. When I say stabilize, there's 4 underlying or 5 underlying currencies. There's underlying government bonds. So you need some way to stabilize the value, similar and akin to if you bought S&P 500 exchange-traded fund, you always want it to trade in line with the underlying. In essence, the holder of the Libra token holds currency risk because they have that underlying, or they even hold government bond risk. Let's say if the UK government stubs its toe in Brexit, which is not like implausible, and the government bonds of the UK trade at a different level than they used to trade. I'm not even saying default risk, I'm just saying market risk. And then there's this other token, the Libra investment token. The Libra investment token strips all the interest. So this is a routine where there's 2 tokens. One token gets no interest. Libra investment token gets all the interest. We used to call that in the early days the carry, the float. But the carrier of the float goes to whom? The members of the Libra Association. It was 28. It's now 27. PayPal left. By the way, if anybody really wants to see about the ambition of Facebook and the political insensitivity, look at what they said when PayPal left yesterday. And it read like, it basically said, we only want committed members. This is going to be a tough fight. We think you should only stay committed. But it read to me like, don't let the door hit you on the way out the door. Like they're very kind of upset that PayPal left. Visa and MasterCard might leave. The rest of the design. It's on a blockchain, which builds on some of the consensus protocols out of Hotspot, but it's a permission ledger. Now, they say 5 years from now we'll go to permissionless. That doesn't seem plausible to me for a bunch of market incentives and technological reasons, but they do put a stamp in that or a pin in that going forward. And that the Libra Association is a Swiss nonprofit. Under Swiss law, nonprofits can pay dividends, but it's a Swiss nonprofit. And then the wallet. And we had somebody from the wallet speak in the other room earlier. So what are the public policy considerations? I think of three big buckets all the time. This is how this former regulator, I served at the U.S. Department of Treasury. I was chairman of the Commodity Futures Trading Commission, and I helped Paul Sarbanes write Sarbanes-Oxley. So I've been kicking around the public policy space for 20 years, and 20 years before that I was at Goldman Sachs. Yeah, that's the math, 40 years. So where's Facebook come out on this? The reserve, to me, the reserve doesn't look much different than an exchange-traded fund or an asset management account. In the law, we call that a pooled investment vehicle. Now, I can tell you what they are trying to do with good lawyers is they're trying to say, well, we're not going to trip over the Investment Company Act of 40. We're not going to trip over the various pooled investment laws in Europe by keeping it mostly in cash. And there's a theory and a legal theory that might even work that if they keep 60% of the underlying assets in cash and the other 40% in short-term government securities, they might sidestep the technical definition of a pooled investment vehicle. I've actually testified to Congress and say, well, then we should change the law. But I mean, that's what they're trying to do, and I don't fault them for that, but I get it. I think to regulate it under money transmission standards makes no sense. In the US, that would be 50 individual jurisdictions. By the way, Montana doesn't really have local law, but it would be 50, including the District of Columbia. I think we're going to have to consider doing something like the People's Bank of China did with Alipay and WeChat Pay, and that they basically said if this gets big, if there's a lot in it, that it has to be invested directly in either bank account money or central bank money, but it can't have any fractional lending within it. There's a bunch of issues around the wallet itself. Calibra, the wallet, will be a custodial wallet, so it raises custodial issues. Like any other wallet raises custodial issues of hacks and cybersecurity, but this could be a big pool and bring in a bunch of wallet issues. What I call don't lose it, use it, or abuse it, but also data privacy. And then the blockchain itself, an interesting thing, and this would not be something you would think much about, but the interesting thing is the blockchain, could it get so large that it is basically a systemically relevant clearing system? And there's a set of rules around systemically relevant clearing systems that are promulgated by CPMI, which is in the same building as the Bank of International Settlement in Basel. But it's basically to make sure that payment systems stay resilient. And then there's a whole bunch of questions about the Libra Association and monetary policy. So where it leads me, I think, is to these buckets. This is a typography of what I'm going to predict is happening. Central banks are negotiating with Facebook. Sheryl Sandberg has already met with a committee of the BIS where she kind of flew to Europe and sat in a room with a bunch of central bankers and so forth. Sheryl Sandberg is also testifying in front of Congress, we think, at the end of this month. But they're negotiating with central banks as to how they can maybe calm down the G7 central bankers, none of whom really like this. Partly it's private sector competition with public sector, but partly it's to ensure, just as the People's Bank of China did, to ensure that they don't create a fractional banking or leverage in the system here, and to calm that down. I think that's plausible. I actually think that negotiation, that deal could happen. They're also trying to deal with the securities regulators, and they're trying to work through somehow to ensure they don't get caught up in the Investment Company Act as a pooled investment vehicle. I have already said I think that's kind of a mistake, but I get why they want to do that. They want to be lightly regulated. I think they're dealing with a bunch of anti-money laundering, the same issues Bitcoin and everybody deals with. But in that third bucket, the question is whether they will move digital ID into the protocol. This is a permission ledger. You could literally put the KYC inside the protocol, but then there might be fewer people want to use it. But that's one thing. Finance ministers are worried about systemic risk, particularly in developing countries. And right now, Facebook is not reaching out to many developing countries, so maybe the IMF can help there. But I think that's a real issue because in a developing country, you might be worried that in the future somebody could liberalize instead of dollarize. You might sort of start to use this. A bunch of data protection issues and a whole host of governance issues. So that's kind of like where I think this is, governance being anti-competitive behavior that could happen within the trade association itself, the Libra Association, or anti-competitive behavior that Facebook now has and says you must use Calibra for our 2 billion members. So all of these things are actually solvable, but my hunch is it's going to take a while. Mark Carney, your former boss, right? Mark Carney, who just stepped down or is about to step down at the Bank of England, gave a goodbye speech at Jackson Hole, sort of after his 7 years. And what was interesting, he said there's a big flaw in the international monetary system, and he basically pointed to the US dollar's dominance. And the US dollar is like half of international invoicing and 2/3 of the currency markets, et cetera, et cetera. So Mark, and I think Mark's a very talented individual. He said, well, maybe it's time to have a synthetic hegemonic currency, which is basically saying, can we use digital currencies to have something that's backed by 4 or 6 or something currencies? Not necessarily, he was not endorsing Facebook, but it's interesting. What's happened is, in a sense, Facebook, Bitcoin, and yes, even Telegram and the rest, all are basically being a big catalyst for change. I think the adoption of Facebook is very uncertain, not just because of the regulatory issues, but just, do I really want to go into Starbucks and spend a token that's backed by 4 other currencies? The history of monetary economics suggests otherwise. Suggests you want a currency tied to your local local economy. So I think adoption is quite uncertain, but even so, I think Libra has created another spur to central banks to do things. So with that, it's Q&A time. And I ask one thing on the questions. Could you only ask one question? Because if you ask 2 or 3 embedded in your question, I'm only going to answer one.
Okay, folks.
So my question is, how do you see this in the context of economic literature that has talked about the competition of currencies, Hayek, for example? I mean, what is happening is really interesting. Is this also a field of research of yours?
It relates to it. And I think that, look, we have 180 currencies around the globe, and there's a great deal of literature about it. This is private sector competing with public sector currency. And we've had a long history of private sector currencies as well. The 19th century here, we had the whole wildcat banking and banknote era. I think the official sector, I think money is a social construct and money itself is a public good. If well managed, I think there's very little room for this. And when I say well managed, I mean if the central banks around the globe filled a lot of the pain points. Right now, the US Federal Reserve manages their currency reasonably well for stability, but I would say hasn't managed it as well for payment pain points. I think by the mid-2020s they will. because they're getting kind of a burr in the side to have 24 hours a day, 7-day a week sort of functionality of digital money. So where does this fit into the history of money and the economics? I think positively, because it's spurring central authorities to do their jobs better. But I do think in countries that lose control of their currency or don't fill the digital payment gaps, and there's a lot of digital, I'll call them digital payment gaps, then there's a room for this to sneak in.
Okay, next question.
You want to go first, or? Okay. So to build on that, I'm thinking of there was a report by the World Bank describing how the correspondent banking network is decreasing. So, like, is that relevant to the payment system you mentioned, like the cross-border, like forex exchange? Like, how do you see that playing with like digital currencies and CBDCs?
The answer is yes. For those who don't know, the correspondent banking system's been around for, well, centuries actually, and it's a question of trust. If you're moving money, particularly between countries, unless you were really a big family in the many centuries ago, or a big bank, you didn't know, and you needed some bank to vouch for another bank, and that's in essence a correspondent bank. So it's a trust mechanism. I think these technologies can solve a lot of that, maybe not all of it, but if you can trust the protocol, and particularly cross-border, you have to have something, even between fiat currencies, you needed a way to jump ledgers. So you need a way to do atomic swaps in the cross-border mechanism. You could lower the need for correspondent banks, maybe significantly.
Okay, thanks for that. Okay.
Hi. So I was curious. What do you think about the world is moving away from the gold standard, right? So like a physical asset back the fiat currencies. So do you think we will see this trend return, or we will see this trend going further and further away?
Well, we only live with the gold standard for a while, 50, 60 years here in the US. And all money is but a social construct. Even gold, which has a wonderful 10,000 year plus narrative, it was only valuable because we humans decided it was valuable, and it was really darn hard to pull out of the ground. And Aristotle wrote that there was 4 reasons behind money, and it had to be durable, it had to be portable, divisible, and Aristotle wrote that it had to have intrinsic value. And I'm willing to say I disagree with Aristotle on that one. I agree more with Plato, who didn't necessarily agree with that last point. Plato didn't write as much about money, but I don't think we're going to go back, quote, to a gold standard. But what digital currencies, non-official sector digital currencies like Bitcoin are trying to do is trying to put the scarcity in the protocol. That there'll only be 21 million coins and so forth. But that protocol can change. Ethereum has changed its protocol twice, with the block rewards going from 5 to 3 to 2. I still think there's a role for humans, especially in tough economic times, to intervene and have some human involvement in monetary policy. But I don't think we're going back to a gold standard.
Okay. This guy. It's difficult to get to you, and that's why I didn't get there.
I was just wondering, why doesn't Facebook want to be a pooled investment vehicle? And you said you think they should. Like what specifically are they trying to get around?
There's a tendency and a trade-off in commerce as to whether you want to be regulated or not. But there's a tendency that there's cost and restrictions to regulation. And on the other hand, you can get some credibility, and you can even build some barriers to entry. So I'm just saying, strictly as a commercial matter, I think they are right now more in the camp of They want to get the central banks, the securities regulators all around the globe to give them permission to go ahead, but they want to have the least amount of cost. They're not really looking for barriers to entry because they're so big, they're not terribly worried about startups. So I think that's their thinking. The restrictions that come with being under the Investment Company Act of 40, I think they could live with them, but they don't. And they really very much want to, and I'm glad to do this offline to give you some of those restrictions. But it's very similar to why a lot of entrepreneurs don't want to come under the securities law when they do an initial coin offering as well. So you have more obligations of transparency, disclosure, who the investors are, keeping track of the investors. You have some fiduciary duties as well. So they're trying to avoid those things that come along with managing a money market fund. And that's what this really is. This is an international cross-currency money market fund that pays no interest, but pays all the interest to somebody else.
So you spoke about the view towards central bank digital currencies and individual central banks, but I'd like to ask a question. If you look a bit, not so much down on the market, but sort of up, what is the impact in your view towards SDR, given that the Chinese renminbi is part of the SDR, but it's not part of Libra?
So just a little background. When after the World War II and the new monetary system was put into place, that the IMF and the World Bank came together at Bretton Woods, there was this concept that there, instead of gold, back to the question of gold, maybe there would be a cross-currency stable thing behind it called special drawing rights, SDRs, which I guess you guys still manage, right? You have some involvement in it. It's a claim on assets. And somewhere in the last 15 or 20 years, the basket behind that became 5 currencies, renminbi and the 4 Libra currencies, if we wish. The SDR is not used in international commerce. About half of worldwide invoicing are in US dollars, and then after that but the SDR has a very limited use. But economists love to write about it and love to think about it and debate it. And I think it's part of work of Christian is thinking about the SDR to come up with this Libra basket as well. The challenge is that the history of money tends towards uniform currencies within one economy. And Mundell and others, loads have written about it. And so I don't know whether there's an implication for an SDR. Mark Carney would like to have some synthetic hegemonic currency, so like a retail SDR. But I still think Mark's perspective, with all respect, Christian Catalini's perspective at Facebook still comes down to the hard challenge of why, if I'm walking into a cafe in Mexico, do I want to have something priced in some other basket? And I think it's only likely if that central bank and that government is losing control of its this social construct, its money, the Mexican peso. And then I think that economy has a question, which nobody's going to vote on. It's going to be just millions of little transactions happening. Do they turn to dollar, like in Venezuela has largely dollarized because they've lost control of their monetary policy? Or do they liberalize or SDRize or a synthetic hegemonic currency-ize, you know? I want to take the question from the gentleman in the back who had his hand up for 2 other speakers and didn't get to talk.
No worries. So, in the case of this dollarization, SDRization, Librazation, I mean, it seems like this becomes almost like a product adoption problem less than an economic question because it's getting people to do it kind of without thinking about it because it's there and embedded in the things that you're using, which makes it less about what economists think is going to be good and more about what the sort of UX causes to emerge. And how do you see that?
Absolutely. See, money is a big adoption issue for thousands of years. This is not a new issue. It's like, why did they adopt the drachma here and oh my God, I'm trying to remember the Roman coin. Kevin, can you help me with? What's that? Libras? No, not Libras. But there's called a Libra. What's that? Aurelius? Huh? All right. So, but the point is, it's been an adoption issue for a long time. What we sometimes do is we use the coercive power of government and create what's called legal tender. And by law, we say that merchants must take this either physical or digital representation of money. And so that's sometimes where societies, and this is not just the US government, this started in China under Genghis Khan, where it was like by the coercive act, if you did not take this, you could be in trouble. And then, of course, about a third to a half of most economies are governments, and we can use it to pay taxes. So there's two big advantages to an official sector currency that's a little tricky in this environment. But you're right, it's a collective action and adoption issue. But we already live in a digital currency age, and if the government of Venezuela really trips up and fouls up, or another country in the future, it's plausible to me that you could turn to something that then maybe Bitcoin's been around for 3 decades, or Libra's been around for a couple decades, and it appears, safe and so forth.
Okay, folks, so it's 1 o'clock now, so I just want to say thank you to Gary and Bob and Tony Maggi. Thank you.